Hey everyone, welcome to the show. My name is Sam Shaw and I'm the founder of Wall Street Mastermind. This is Wall Street Mastermind's Elevate program, where we take our flagship coaching program and give it away for free to high potential students who are currently in a difficult financial situation. The goal of this show is to first and foremost give these students the coaching and guidance that they wouldn't be able to get otherwise and help them break into investment banking. Of course, we also want to give all of you an in-depth look at how to go about your own investment banking preparation process the right way, so that you can model it after the same proven methodology and strategies that we've used to place over 90% of our students into investment banking across every single bulge bracket and elite boutique bank over the last several years. With hundreds of thousands of applicants competing to break into investment banking globally each year, our team only has the bandwidth to help a very small percentage of you. So my hope is that this show helps all of you, even if you aren't able to directly participate in our program and work with us. So let's get to it. In this session, we continue to prep for more upcoming interviews that Ximena has, specifically with Citi's Financial Institutions Group, also known as Fig. We talk about some Fig-specific technical questions, as Fig is one of the few industry coverage groups that require additional technical prep. We also go over some Fig-specific behavioral questions as well. Hey, Ximena.
Hi, Sam.
How you doing?
I'm doing well. I'm going. How are you?
Good. What's going on? Did you hear back from MS?
I did not. Not yet.
Okay. You're waiting. They told you to wait a week, right?
Well, so the director had told me you should wait around a week. He said around a week. But then I had an interesting conversation with an associate, he's an analyst now, who had told me that last year, he basically was very close with the program. He had been at an MS program since his freshman year. So he was very well connected. And after his interview, he had been connected with somebody who told him that afternoon, like he called him and told him that he had gotten the offer, but he heard back from the actual HR team 3 weeks later, even though like, he already knew he had the offer. But at the same time, I had spoken to somebody who interviewed for this program about 2 days before interview. So we both wished each other good luck, and he got an offer the day after. So not too sure.
Yeah, I mean, it seems like there are people that have gotten offers already, but I also know there are people that have already been rejected. So,
Okay.
yeah, so so I mean, we can try to read the tea leaves and whatever, but yeah, who knows? But if he told you to wait about a week, it's been a week, right?
Yeah.
So are you gonna follow up, or?
Yeah, I guess so. I don't know. I remember with the JP how I kept following up, and I don't know. And then I ended up getting the rejection. But I think I will, since he told me specifically that.
And
yeah, I think it's just one of those.
The director that said a week, he was one of your interviewers, or?
No, so I believe that sometimes the bank tells the school's like recruiting team that like, oh, this person got it, because 2 people reached out to me after I passed the first round that I had never done before. And they said, hey, we're on the NYU recruiting team. If you need help or want any questions answered, like we'll help you prepare. So he was one of them. And then there was another analyst who reached out. So I talked to him the night before, and he basically walked me through what it would be and what the interview was going to be like.
Got it. Okay, so he's on the NYU recruiting team, and he's just helping you out basically, but he's not interviewing. Okay.
Yeah. And then I don't know, because with one of the interviewers, well, I guess it's one of those things where you try not to over read between the lines and everything that happens. But yeah, the email just said like it was great talking to you, keep in touch. So that's what one of the interviewers said, who I got really well along with at the end of the conversation. So when he said keep in touch, it made me think like maybe that's a no. And he was like, well, you're cool, so keep in touch. So I just didn't know how to approach that either.
No, I don't think that's what it means. I mean, yeah, I definitely don't think that's what that means. I wouldn't read into it that much. I guess it depends. It depends on like, what else you have going on in terms of processes and timelines, because you want to be strategic about whether you push MS for a response sooner or not, So Are there other processes that you're kind of juggling at the same time right
Sam,
now?
I think you're cutting off.
Am I cutting out? Can you hear me? Shimona? Uh-oh. Okay, so anyway, I have some Wi-Fi issues, but what I was saying was it depends on like what other processes you have going on and competing timelines and things like that, right?
Right.
So what else do you have right now and what are you waiting on, if anything?
Currently, it's Citi. So I have first round tomorrow. So I have one tomorrow, and then the other one is Thursday.
So, got it. So City is tomorrow and what's Thursday?
The same. So it's two. They're not back to back. So there's one phone interview tomorrow, and one is Thursday.
Got it. Okay. All right. So you got City tomorrow and Thursday, but that's the first round, right?
Right.
Okay. And is that through diversity or is that the regular
Yeah, that's from the early ID.
early ID? Okay. 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 And then the rest you're still waiting on? Wasn't there something for Evercore or something?
No. So for him, I had talked to an MD. I just talked to an MD who had told me, let me know when you apply. So I let him
Okay.
know. And then no, that was just for the MD. And then, well, I've been a part of like their Evercore coffee chat, and I've gone to like their events when their NYU events because they have a recruiting team for
Yeah.
that. But that's it. I haven't heard anything back.
Okay.
Which I think, I don't know, I'm confused. It seems like a lot of boutiques are already going through. I don't understand, like boutiques don't have a diversity, right? They're just pretty much going.
No, they have diversity programs.
Oh, really? Yeah, right. But they did that a while ago, right? Or are they not starting? It just seems like a lot of banks aren't
No,
interviewing yet.
no, I think I don't think all the boutiques have started interviewing yet. Like I know like Lazard has.
Mhm.
They seem to be one of the earlier ones. And even that I think might have been for diversity.
Okay.
And then yeah, I don't think like all elite boutiques have started interviewing. Some elite boutiques have. I know like Centerview in Palo Alto. They've started interviewing as well. Um, but yeah, I don't think it's too many. I mean, there might be a couple others, but I mean, the other thing you could do is you can interview with City first and see how that goes. And then, like, I don't know when the super day would be, but if you get the super day and if it goes well, then you can use that to come back to MS and um, ask them for an answer. But then you have a competing offer, and so it makes you a bit more like desirable in their
Mhm.
eyes, right? Because there's a possibility that you're like a maybe right now,
Mhm.
right? Because like some people have already got offers and some people have already been rejected and you haven't heard. So if you're like a maybe, then maybe they're like waiting to do more interviews or whatever before they tell you. That's also a possibility.
Okay.
But then if you have an offer from like City or a competitor and then you tell them about it, then you know that could move the needle, right?
Okay.
Yeah. I don't know. What do you think? What do you feel like doing?
Yeah, I think because I'm in that process, I think that would be best because I feel like so if I reach out right now and I'm still waiting, like that's all they're gonna say. They're not gonna say like, oh, right, you got the offer. So they'll still say like wait. So I do feel like it's best to wait to see how it goes with City,
Yeah.
just because then there's like a reason. Like I need to know. Right now I don't really need, I mean, I would love to know, but it's not like a competing offer.
Right.
Um, so it's more like anxiety, but I guess I've learned to just, you know, it's better to
Yeah.
just wait to see how things go.
Okay. All right. So then, I guess right now, then, what's most important for you is prepping for the City interview, then, right?
Right.
Okay. How's that
So
going?
it's good. I'm interviewing, so it ended up being I am doing the Fig team. Um,
You're
that's
doing
what I
what?
was assigned to, the
Oh, the
Fig team.
left thing.
Yeah. Just Fig.
Is that
Not,
the thing that the MD is on, the one that helped you?
yeah.
Okay.
So I've like mostly networked with people in that team. So that's who I'm connected with the best. And
Okay.
that's yeah. So my mentor was in that. So I was a little bit confused just because my mentor was in fintech and a lot of the other people I've networked with are in insurance. So fintech technicals are very different than like insurance or banks or anything. So I wasn't sure how those technicals were going to go because in the early ID program, we just did normal technical prep, just going over concepts. But
Yeah.
I spoke with someone in the Fig team who I believe he's one of the interviewers for Fig, and he said, yeah, to just kind of know basics. So I kind of wanted to go over that with you of like, I think I'm grasping the concepts of like how to walk through a DDM and kind of the different ways, but there's a couple of things that I'm still a little confused on.
Okay. All right. It's the Fig team, not the left fin team. I misheard, but okay. All right. Yeah. I mean, let's give it a shot. I don't know. I've never done Fig banking, so I actually am not like
Okay.
super well versed on Fig specific technicals, but we can give it a shot. What questions do you have?
So okay. So one thing was I just wanted to clarify. So normally, okay, dividends are used rather than free cash flow because free cash flow, like normally interest makes a large part of like the kind of revenue that financial institutions are generating. So
Yeah.
free cash flow isn't used. And normally a better indicator, that's why you use a DDM. You don't do a DCF to forecast cash flows, you use a DDM.
Yeah.
Because it's after, but then I think the part where I was confused was, so then why wouldn't you just use levered cash flow because that's starting from net income? But I guess the other part of that is like financial institutions have very low capex, but you still subtract that. So I was confused as to why wouldn't you just use, maybe just clarification of why maybe not just use levered free cash flow and you use dividends.
So I'm looking this up as I'm explaining this to you, but it seems like the explanation is that free cash flow is meaningless is because changes in working capital can be massive due to the balance sheet centric nature of their businesses. And CapEx is minimal and is not directly related to reinvesting into their business.
Mm-hmm.
So I guess if you're using a DCF, then you would take free cash flow plus or minus changes in working capital minus CapEx, and then that would get you to like the amount that you're discounting back, right? But since those two line items, the change in working capital and the CapEx are not really relevant, then you use a DDM, which basically ignores working capital and ignores CapEx, and it just takes the dividends. It takes the dividends that the firm issues and uses that as a proxy for cash flow, right? So, I mean, that makes sense to me as I'm reading about it. But
yeah,
what was your
about
question
the working capital?
Yeah,
because for some reason I was thinking CapEx, but yeah, I mean, yeah, that makes sense. I don't know why. So it's the working capital, I'm guessing. That's okay.
Yeah. And then I think you just need to know how you was like the steps to setting up the DDM, right? So do you know how to do that?
So the only thing is like so initially there's like a simplified way, but then I was just watching a video that said that a lot of people make that mistake where they say that dividends are a percent of net income, but then there's the whole like tier one capital, which is kind of like, I think it's like the reserve that banks have to have, which is what you have to put into the equation. So I just have to clarify that's part of so dividends aren't just a percentage of net income. You have to take into account the percentage of tier one capital, which is like the reserves. And from there, you project the dividends out. and then you discount them back using the cost of equity to get the net present value of the dividends. And then you also have to calculate a terminal value. And instead of using EBITDA, because that's irrelevant and you need to have interest, you use P to BV or the Gordon growth method.
Yeah. Yeah, I think
And
like
you discount that back.
Yeah. Yeah, I think if we summarize it,
value. Yeah.
I think if we summarize it, essentially, you first project the dividend, you first need to project like the underlying asset growth, right? So like if it's a bank, it'll be growth in assets or loans, right? And then if it's like insurance, then it'll be like the premiums that they're collecting on their insurance policies, right? So you grow that, and then you have to assume. I think what you're talking about is like the minimum regulatory capital ratio, right? Which is how much shareholders equity, a certain amount of shareholders equity that you're going to have to basically meet this requirement, right? And that's, again, depending on if it's a bank or an insurance company, it will be linked to different things. Like for banks, it's linked to risk-weighted assets, and then for insurance companies, it's linked to net written premiums, right? Which again is just that top line that we just talked about, right? What's the percent growth on either loans or premiums, and then like based on the required shareholders' equity and the net income each year, then you can back into how much dividends is issued, right? And you discount that back using cost of equity, and the rest is pretty similar, right?
Yeah.
If you do terminal value, the multiple would be different. It wouldn't be like the EBITDA multiple like we typically use. It would be price to book value. And if you do Gordon growth, then you discount it using cost of equity instead of the WACC, right?
Right.
So I think that's pretty much the same as a DCF, but the only difference is that you have to back into the dividend amount based on the regulatory capital requirements.
Okay.
Right. So like you can't just make your own operating assumptions. Like it's like legally mandated, and in a way that almost makes it easier because there's less room for interpretation. Right.
What did you say? There's less room for what?
There's less room for interpretation.
Oh,
right?
Yeah. Okay. So that makes sense.
What have you been using to learn this stuff?
Breaking into Wall Street, just watching videos. I think it is one of those things where it's like after going through your program, when you understand concepts and when you look at models, it just makes sense. I think that's where like the models really help, where like when you're actually understanding and you get the concept. So that's most of what I've been doing.
Yeah, and also they have a Fig specific guide. Do you have access to that? Because
I went on the Facebook group, like you have a guide for Fig. That's what I've been also reading on.
Yeah, so they have a Fig specific guide that has just like practice questions and stuff in there, which you can use to test yourself on. So I would definitely look at that if you haven't yet.
Okay.
But yeah, I mean, like you're right. Like all of these industry specific technicals, it's like as long as you have the underlying technicals learned already, then learning these is just like a variation of those, and it's not really that hard, right?
Right.
So, okay, all right. What else? What other questions?
Okay. That was for that, and then I had a really quick question from the office hours yesterday, where it was if you have a very big difference between, this is just basic, but a very big difference between when you calculate the terminal multiple and the terminal value based on the terminal multiple and the Gordon growth method. So it was if your Gordon growth method is much, let's say, higher than your terminal multiple, that would mean that like your assumptions for the cash flows that you're projecting out are too strong, right? because you're getting such a high value. So you would need to like reduce the growth rate that you're.
Yeah, I think I'll put it this way.
Right.
Like, so if you do the terminal multiple method, there's really only one variable, right? Which is like how many times EBITDA am I going to assume, for example, right? And for that, like, you're just going to look at your comps and pick something that seems reasonable based on where the comps are trading, right? But of course, like, it's the part that's a little bit arbitrary is like, say your comps, they're going to trade within a range, right? So say they trade within like 15 to 20x. So then, like, should you use 15 or should you use 20 or should you use 17 and a half or like, so there is some like wiggle room, right? And so how many turns of EBITDA you use, that's the variable if you use the multiple method. On the Gordon growth method, the variables are what? The perpetuity growth rate, right? And then also the WACC, right? And so essentially you have like 3 variables, right, that you can play with. However, the perpetuity growth rate, that one is probably like the one you wouldn't play with that much because that number is relatively fixed because you can't grow faster than the GDP into perpetuity, right? The reason is if you are growing faster than GDP, then eventually you would be bigger than the entire GDP, which doesn't make sense. So like typically like that perpetuity growth rate is like somewhere within like 2 to 3%, I think, right?
Right.
So now really you just have 2 variables to play with. You have the WACC if you're using the growth, or you have the how many times EBITDA, how many turns of EBITDA if you're using a terminal value. So then like when you whatever initial assumptions you use for those 2 assumptions, you're going to get to 2 different terminal values, right? And then you can basically compare the 2 terminal values, and if they're really far apart, then you got to ask yourself like, either I'm going to have to move one of those. I have to either like move the WACC or move the multiple, and I either have to like which direction depends on like which one's higher, but like you just want to get them to be like relatively close to each other, but still have both of them make sense. Like it doesn't make sense if your multiple ends up being like if you're concentrating at 15 to 20 and you're like, oh, my EBITDA multiple needs to be 30x for this to make sense, then you know that's probably wrong, right? But then you're like, okay, well, if my multiple has to be in like the 15 to 20x range plus or minus, what does the WACC have to be so that I can also have a reasonable WACC and still have both of those things be relatively close. It doesn't have to be exact. It'll never be exact, but it has to be like in the ballpark, right? So that's all I was saying is like that allows you to kind of like you're triangulating, right? And that's all evaluation is you're looking at it in a lot of different ways and you're triangulating. Say, hey, if I do it this way, I get to like this range. If I get this way, I get to this range. Like you can lay all this out on a football field, right?
Yeah.
So that's what I meant there. Does that make sense?
Yeah.
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 Yeah, because the WACC, like also the WACC, like because you had to calculate it using, CAPM and your cost of debt and stuff like that. So like your WACC, there is a reasonable range for your WACC also, right? Like usually whatever you end up calculating, you might add like 1 to 2% in either direction. That's about it. Because even a 1% move in WACC can create a big difference for your enterprise value, right? Does that make sense?
Yeah.
Okay.
That was that. And then I lost this, but there's this question that's really somebody tried to explain it. It was on IB Vine, which I think is very basic, but I think I'm just not understanding the fundamental concept of this, but okay, so it was these two. So how does so it's calculating just enterprise value based on like equity plus net debt, equity value plus net debt, but it's so if you raise 2 million in debt and you use cash to buy a new piece of equipment, how that affects enterprise value, and then it would go up by 2 million.
So if you raise $2 million of debt and use that to buy equipment,
right?
How does that affect enterprise value?
Right, which, okay, so it goes up by 2 million because so even though you bought equipment with it, you haven't paid down the debt, right? So you wouldn't subtract cash. That's the logic for that, right?
Yeah, because buying equipment is just CapEx.
Right.
Right. So like Catback doesn't really affect the enterprise value calculation. Like it's not one of the variables, right? When you raise debt, you get $2 million of debt, you get $2 million of cash, right? Both of those things go up.
Right.
And so when your debt and your cash both go up together, your enterprise value doesn't change because your net debt didn't change, right?
Right.
Because debt and cash are both $2 million, they net out against each other. So your net debt increased by 0, right? But then when you take the cash and you spend it on equipment, now your net debt balance is actually higher by 2 because your cash, even though you got $2 million of cash when you borrowed the money, you now spent it. All right. But the $2 million of debt is still there.
Right. Okay. Yeah.
Right. Does that make sense?
Yeah. But then if you issue 2 million in equity for an IPO, then it's unchanged.
Yeah. So if you issue 2 millions of equity, then the enterprise value is unchanged, right? Because your equity value went up by $2 million, but then your cash, you also got cash, right? So your cash also goes up by $2 million, which means your net debt decreased by $2 million. So it just nets out, right?
Yeah.
Does that make sense?
Yeah. Okay. Yeah. Okay. Those were the two main for that. And then, yeah, I don't know, maybe just basic technical run through.
Okay. Yeah, I mean, like the other thing too is, I mean, I don't know how detailed they'll go, but if you go into like just kind of know like the different sub verticals within Fig, right? Like it's not just, I mean, there's banks, there's insurance, there's specialty finance, there's brokerages, there's asset management, there's fintech. And so just kind of know like the difference between each of those things.
Right. Yeah. I was going to put that in my Fig answer based on what they told me, but I wasn't sure. So they said it was banks and diversified financials, asset management and insurance, and fintech was for Fig, which I'm guessing it's just Citi. I don't know because there's so many more.
Yeah. I mean, every bank's gonna be slightly different. So I guess like, what's your why Fig answer?
So my why Fig is one. I think Fig. I'm very interested in Fig because it has a lot of deal flow compared to a lot of different groups. From the associates and analysts that I've talked to, they've told me that they've been able to have a lot of more deal flow than a lot of their peers that work in other groups, and I think that would be a great learning experience, starting as an analyst. And second of all, I think working in Fig provides a unique learning experience. You could be placed in banks or diversified financials, asset managers, and insurance, or fintech. I think fintech is very interesting because there's a lot of consolidation with companies trying to adapt to new technologies today. And as a lot of them are starting to go public, my EID mentor, blank, told me about how he's had the opportunity to work with unicorn companies and what a great learning experience that has been after also networking with managing director. So he told me about his long career working in insurance and how entrepreneurial and interesting it's been. So I think regardless of what group I get placed in, I will have a great and unique learning experience.
Okay. So I think like the three reasons that and you do give some of these reasons, but I would maybe just like frame it slightly differently. So for example, the first part you say like, hey, you get a lot of deal flow from a lot of different groups. I wouldn't say like from a lot of different groups, but I would just say Fig is the most active industry group out there in terms of deal flow, right? And like even if we look at like the league tables, let me see if I can find it. But yeah, Fig has like by far the most deal fees, if I'm not mistaken. Yeah. So if I look, if I showed, I might have showed you this before. But like if I go to the ft.com league tables, like they show like the best team within each vertical. And so this is not like Citi specifically, but even then, like you look at the top team in Fig, they made almost $4 billion in fees just in 2021 versus the second most deal fees is technology, and then the third is healthcare. So that's not surprising, right? But like there's a huge drop off going from Fig to tech. And then like there's like a cluster here and then like pretty big drop off down here, right? So like being in Fig is like by far where you're gonna get the most activity and deal flow happening, right? So I would mention something about like, Fig has the strongest deal flow. As far as I know, Fig has the strongest deal flow out of all the industry coverage groups out there, right? Just like when you look at the number of deals, when you look at the amount of fees generated, Fig is by far the largest fee pool, right? And that's important because more deal flow means better learning experience for you, and obviously, like you want to work in a group that's generating more revenue for the firm because that means it's a more important group, right?
Yeah.
Second thing that I would say is I think you talked about it's a great experience because you get placed in banks, you diversify financials, you asset manager, fintech. So I would just say like I would probably say like the Fig group consists of a lot of different sub verticals such as X, Y, and Z, such as banks and insurance companies and diversified financials and fintech. And the reason why I think that's really great is because all of these different sub verticals, they're essentially like a different type of business model. So I get to learn about. I'm not just like doing a lot of deals, but I'm also doing a lot of deals across a lot of different types of companies and a lot of different types of business models. And like that's going to give me a more well-rounded exposure, which again, this is also just like a different angle, but tying back to like a better learning experience for you, right? And then lastly, you can just talk about how along similar lines, like what you've learned from speaking to bankers is that Fig Group is one of the most technical groups out there, right? Probably because you have to learn to model all of these different types of business models, and they're all different in terms of how you evaluate these companies and things like that. And so it's going to help you develop a more technical and more robust skill set, right? So I think like all three reasons are kind of like tying back to the common theme of like, hey, this is just going to give me the best learning experience because I have the most deal flow, a lot of different like very diverse types of businesses and business models, and then like it's the most technical. I would probably just focus on those three things.
Yeah, I thought about the technical. I just didn't know if that would invite technical questions. Like, since we're so hard on technicals, like here are all these technicals.
Yeah, that's fair. I don't know if it would or it wouldn't. I guess if you're worried about it and you want to leave that one out, I'm okay with it.
Okay.
Yeah, you can leave it out if you want. I mean, I think they're still probably going to ask you technicals regardless, um, but yeah, I think like it shouldn't be too hard. I sent you a couple articles in Slack too. You might have already read those, but if you haven't, just like read through them.
Okay.
Yeah. And then like do some practice questions with the Fig guide, like I said. Okay, so that's your Y Fig, right?
Mm-hmm.
What about your Y City?
Okay. So Citi, the only thing, okay. So Citi is my top choice because of the learning opportunity, the people, and the attention to diversity. For one, Citi is one of the largest global banks that consistently does well on the league tables across all M&A, debt, and equity deals, generating the highest deal fees. It also has a large balance sheet that allows it to provide a lot more services to a larger pool of clients. And I think being at a bank with such strong performance that has a lot of deal flow would allow me to have a great learning opportunity and a well-rounded experience. Second would be the people, having multiple conversations with multiple different people at the firm. Citi seems to have a very collegial environment, and analysts so-and-so told me about the amount of support that he's had over the past year from the managing director and the VP that have supported him throughout his whole learning experience. I also had the opportunity to talk with the MD who told me about his long career at Citi and what a welcoming environment it is, even after many years of working at the firm. And finally would be the attention to diversity. I had the opportunity to be a part of the Citi Early ID program, which showed me that Citi is really looking towards recruiting diverse candidates and the attention that they're putting towards that, as well as having the first female CEO on Wall Street, I think is a great milestone for women, and it's very inspiring. So those are the main reasons why Citi is my first choice.
Okay. Yeah, I mean, I think the answer for the most part is solid. I mean, if I want to nitpick it, I would say for like the conversations that you have with the people, like for example, it's like the MD, ABC, whoever, talked about how like what a welcome environment it is even after many years of working at the firm. Like I don't know what else you guys talked about, but to me, that wasn't like super compelling because it's like, what does that mean? What a welcome environment it is, or like. Right. I think like it would be more interesting if it was something about how like I don't know how long he's been at Citi, but like if he's been at Citi for a long time, then like you could say something like like he's been working at Citi for 20 years, and he mentioned that like the reason why he's stayed at Citi this whole time and hasn't gone anywhere else is because I don't know, something better than just like a welcome environment. Like it's got to be something more specific, So I don't know if you have anything like that, but I would think about that, right? The first female CEO on Wall Street, I think that was like pretty big news when it came out, and she probably like did a bunch of interviews, and there are probably like a bunch of quotes that came from her. So like if you just like do a little bit of reading on something that she said, and if you can even like quote it and say, I know when she first became CEO, she mentioned XYZ things. Like she probably said something about diversity. Like people probably ask her all the time, "Oh, how does it feel to be like the first woman CEO on Wall Street?" She probably like, so there's probably like something quotable out there, and so you can like. I think the point is like, all of these reasons are fine, but if you just make it like a little bit more specific, I think it would make it better.
Yeah.
Does that make sense?
Yeah.
Okay. So I will try doing that.
Okay.
Let's see. What else? What other questions are top of mind for these interviews? Do you have like a Fig deal and Fig trend that you prepared to talk about?
Um, so sort of, I just decided to do a different one that I'm redoing because with my mentor, we had done which didn't make any sense, but we did Frontier Airlines with Spirit, which isn't a big deal. I feel like he gave me some tips because he's also an interviewer. I think a lot of the people that are doing the program are also interviewers. So he had told me that the prerequisites were just to do a Citi deal. It didn't have to be a Fig deal, but it's just I think.
So you're saying your interviewers are not gonna be from Fig necessarily? Is that what you're saying?
So I know one of them is, but I think some of the questions, well, for the deal specifically, they told me to just have general Citi deals. They didn't have to be Fig specific. I
Yeah.
think I
but
did
they have
find
to
one.
they have to be done by Citi though.
International, yeah.
Okay.
So I did one with Spirit Airlines, and then there's one that I'm trying to understand right now. It's Brookfield Asset Management acquired American National Corp. It was supposed to be a huge deal last year for $5 billion. And Brookfield Asset Management is a reinsurance, so the acquisition would allow American National Corp to generate more revenue in terms of, so this is where I'm confused because from what I understand, insurance companies, so they give out their premiums to other companies that then there's like the whole reinsurance side of it, which is like, then you take that money and then you generate more income, right? I mean, so yeah, I think I just need to understand that process a little bit better. But basically, Brookfield Asset Management has a reinsurance arm that acquired American National Corp, and throughout the pandemic, insurance companies had really high multiples. So a lot of insurance companies have tried to take advantage of this.
Okay.
And yeah, I think I need to work on that one, Brookfield Asset. And then for the light one, it was Frontier Airlines acquired, merged with Spirit Airlines for $20 billion. Since the pandemic, we saw a slowdown in a lot of flights and in the airplane industry. So I think it was interesting to see how these two airlines that have historically been low priced airlines not only merged to take over a larger region of the US, but it also allowed them to become the fifth largest airline in the US. So I think that was really strategic as we're starting to come out of the pandemic to see how they decided to remain strong regardless and take on more of the demand that's going to start opening up as the world opens up.
Okay. How are you finding these deals?
I would just go, I was going on this one my mentor told me about that they did. And then the Brookfield Asset Management one, I found it through Merger Links when I had the free trial.
Yeah. Oh, okay. Trying to think. Yeah, I mean, I'm trying to think if there are other ways to find more deals done by Citi without having some sort of paid subscription, you know?
Yeah. I mean, I guess because they all have paid subscriptions, it's just hard to find somebody that would do that without having one.
NYU doesn't give you guys Cap
Cap
IQ.
IQ. I know that they give NYU Stern Cap IQ.
Oh, but not NYU.
Yeah.
Okay. You don't have any friends at Stern?
I asked somebody who told me to contact NYU Shanghai who doesn't. So maybe I can figure it out, but I haven't.
We could probably ask someone who's in Wall Street Mastermind at NYU Stern.
Okay.
Do you know any of the Stern kids in the program?
If not,
I
I
think
can.
no, I don't personally know any of them.
Okay. Let me. I'll make that. I'll make that a to do for me. I'll find someone for you.
Okay.
NYU Stern, because we got plenty of Stern kids. Oh yeah, here's one.
Really?
Oh yeah, we have a lot of Stern kids. Yeah, I'll ask someone for you. All right. Because yeah, like I think part of the issues with talking about deals is that like if you don't feel like you know the company that well, then it's going to be hard to sound intelligent about it, right? So I don't know like how well you feel like you understand Brookfield Asset Management, or maybe you feel like you just have to use that one because that's the only deal that you were able to find that's in Fig and done by Citi, right? So yeah, I'll look for NYU Stern person with cap IQ. Okay. What about I know you only have a few minutes because you have like a Goldman info session or something, right? So
Yeah.
what about like a trend? Do you have a trend prepared?
A trend. Should this be, so I have a few trends that I've prepared in the past. Would you say I should do? Yeah, I mean, that makes sense, right? A fig trend.
Yeah, I mean, it should be a fig trend, but like, I don't know. I mean, like personally, I myself are like, I'm more of a tech guy, right? So if I had to pick a fig trend, then I would probably pick something like fintech, but because that stuff is like easier to understand for me. But I mean, you don't have to do that, you know.
Right. Yeah. My go-tos were always the semiconductor because I've read a lot about it, or inflation. But I feel like interviewers are getting really tired of listening to inflation. I don't know. It could work for me because I've talked about it, but I could tell in my last interview, they asked me about the geopolitical atmosphere and what I thought of the market right now. And I started talking about inflation, and the interviewer just looked down. And then I like moved into a different concept, and then he kind of re-engaged. So I'm guessing they've heard a lot about it. But I mean, I could talk about it, right?
I mean, you can talk about inflation. I think that's more of like they ask you for something that's like going on in the macro environment, though, right? Yeah. That's not the same as if they ask you for like an industry specific trend, which is kind of what I'm asking you about right now. But also, if they're asking you about like the geopolitical things going on with Russia and Ukraine, I think the other thing that's worth mentioning, which is related to inflation, is oil prices, right?
Mm-hmm.
I don't know if you talked about that.
Yeah,
we did. Okay,
that's what I mentioned. But I felt like I should have mentioned like how there's all these like large corporations that are pulling out of Russia, and how that's going to affect like a lot of companies in the future as like revenues aren't as high as they wanted because essentially they've lost so much business.
I don't know about that because I read somewhere that like the Russia GDP is only like if you compare the Russia GDP as a percentage of like overall global GDP or something, I think it's like a very small percentage. It's not the same as like pulling out of the US or pulling out of China or something like that, where that would be like a huge hit, right?
Mm-hmm.
Like I think I think Russia has a lot of land mass, but I don't think like its economy is actually that big. So
yeah, I think with the oil thing, it's just because I think there's more into it because I think I know the US only has only imports like 3% or like 8% of its oil from Russia. So I was afraid that they would ask me like go into detail, like if that's how much they import, why are oil prices so high? So it's kind of like a whole domino effect of the world and how much interdependence there is.
So I just Googled Russia, Ukraine impact on economy.
Yeah.
Okay. And then like a bunch of articles come up like Forbes, how Russia's invasion of Ukraine could affect Europe and US economy. Like it's probably like a perfect article to read. What's at stake, New York Times, what's at stake for the global economy in the Russia-Ukraine war? Like even if you just stay on page one, I think you'll find some stuff that that could be pretty helpful, and you just kind of like summarize what you read, and it'll probably give you a more sophisticated answer. But I think like when people talk about like what's going on in the markets right now, like it's totally fair to talk about the war. That's like the biggest thing that's affecting the markets. Right? I mean, it's like that and the Fed raising rates. I think there's something about like how the Fed is kind of like in a tough spot because inflation's running so high. The war makes inflation even worse, and the stock market is already wobbly because of those two things. And at the same time, they're trying to raise rates, and then so like being able to explain kind of how that all interplays, I think is kind of what they're looking for.
Really? Because that's what I did. And I started talking about like the employment rate going down. And I felt like I just talked about so many different variables that it was like too much.
Yeah, I mean, you still have to be organized. You don't want to come across as you're just like rambling different things, but I think you have to kind of like follow the framework in the questionnaire, right?
Yeah.
Like we give you the framework so that like, hey, these are I think there's like 4 different parts that I got to hit on to make sure that you're not like all over the place, But if you need me to like look at your answers before you use it, like I can do that.
Yeah. Okay.
Okay. I know you only have 1 minute, but I'll send you this link too. I guess I'll message that person at NYU for you. And let me know if you have other questions before your interview. All right.
Okay. Sam. Thank you.
Cool. Alrighty, keep me posted. Good luck.
Okay. Thank you.
Alrighty, we'll talk soon.
Thank you for tuning in. If you enjoyed the content, please subscribe to our channel or podcast so that you can get notified of all of our future episodes as well. If you'd like to apply to work with us so that we can help you in a similar way, feel free to reach out to our team at www.wallstreetmastermind.com/apply. The street is abbreviated to ST, so it's wallstmastermind.com/apply. Talk soon.